All right. Hello, and welcome back. We're back with Michael Levy of Grand Lux Realty and a special guest, Biagio of Meadowbrook Mortgage Bank. And welcome, everyone. Michael, how are you doing today?
I'm well, thanks, Tim. Hi, good to see you again. Hi, Biagio. Thanks for joining us.
Thank you, Michael. Thank you, Tim.
Yeah, good. Biagio is one of my good friends, and he helps us a lot with our mortgage needs. And go ahead, introduce yourself, Biagio. Tell us about what you do.
Sure, great. Thank you. Thank you both for having me. Thank you for everyone out there. My name is Biagio Maffettone. I'm a mortgage banker with Meadowbrook Financial Mortgage Bankers Corp. I've been in the mortgage business now for about 20 plus years as a loan originator and also as a manager, recruiting and managing large teams at various institutions over my tenure. My motto has always been, put the customer first and everything else will follow. So I'm always consumer centric. And really listening to the customer's needs. And I always say I'm not as much a mortgage broker as I am a consultant, kind of holding the client's hands throughout the process. It's the biggest purchase most clients will make in their lifetime. So with that comes a lot of anxiety and stress at times. So I consult, I hold hands, I do whatever I can to make the process more seamless. And Michael's been a great business partner of mine in his office. I work with his agents. And it's been great. So thank you for having me.
Yeah, one of the things that a lot of people maybe understand or maybe don't is that there's a difference between getting a mortgage from a bank versus getting a mortgage from a mortgage broker. And you're a mortgage broker, right?
So I'm actually a mortgage banker, but the distinction that you're trying to make, which I totally understand, is the difference between a retail bank and a mortgage bank, a non-bank, if you will, mortgage provider. So the difference between a mortgage bank and a mortgage broker is that a mortgage bank is actually closing the loan in their name using their own money or warehouse lines that they have access to. Whereas a mortgage broker is not closing in their name. They're just brokering the loan out to other institutions. So there's advantages and disadvantages that come with both. I won't get into the nitty gritty, but a retail bank like a Wells Fargo or Chase, which I've worked at as well, Wells Fargo, namely, they have one set of guidelines, they have their rates, and they have their box that they want to fit, the mortgages into. So at a mortgage bank, a non-retail bank, if you will, I have access to, 50 different lenders. So we're constantly looking not only for best price, but best fit for the consumer because of his or her situation. So there's a lot more flexibility between a retail bank and a mortgage bank.
Right. So you usually recommend that if a borrower comes to somebody like you versus going to Chase or Wells Fargo, that they have more options.
Correct. Yep.
Right. Which may lead to a better rate, less points, less fees, or whatever.
It could, it very well could. In some cases, I've actually told clients that they're better off with their, mortgage bank, their retail bank that they're currently with, because they have a lot of money with them and they have, preferred rates for them and whatnot. So there has been instances where it worked the opposite. And my whole thing is I rather have the customer get the best opportunity that they can get, even if that means myself not doing the deal. I'm at a point in my life where I've been doing this for so long, and I really found out that once you put the consumer first, it does reap the rewards later on. And I've had consumers thank me for that and say, you know what, I appreciate that advice, but I'd still rather go with you. So, it's worked well for me.
That's nice. That's nice. So obviously, real estate sales and mortgage broker and banker work go really hand in hand. And a lot of buyers are out there thinking about buying soon and getting ready to buy. How early in the process do you recommend that buyers should be reaching out to somebody like you when they're getting ready to look? right? If for us, our office policy is we don't need a pre-approval letter to show a house, but we do need a pre-approval letter to make an offer. That's our office policy.
Right.
But obviously, a lot goes into it for a buyer to get ready to get to that point. How early in the process do you recommend buyers should be contacting you and getting ready, getting their financial situation in order to get ready for this process?
Yeah, good. Great question, Michael. I always say as early as possible. Some of my sister-in-laws have recently gotten married. They're not even thinking about buying a house today, but I already told them, let's run your credit. Let's take a look at your financial situation, because one day you do want to buy a home, even if it's a year from now. And the reason why I do that, or I advise clients to do that, family members included, is because there could be things that are on your credit, for example, that could pose an issue. And I'd like to try to get that cleared up as soon as possible. And time is on your side, right? When you're doing it earlier in the process. Likewise, some clients want to put down X amount because they want to avoid PMI, let's say. So we start talking about that conversation as well, as about saving their assets so that they do have that larger down payment. Maybe they don't have to put a larger down payment, but they want to. So, we have that conversation. I found that some things there could be erroneous things on your credit as well. So that sometimes is just a matter of calling the credit bureaus and having them cleared up. Sometimes it's not an erroneous thing, but in time, it passes, you get it, it gets seasoned, if you will, and then the score will start going up again. But if you're unaware of these things, I'll give you a quick example. My brother-in-law had a collection account from Verizon for like $35 that he was unaware of, that was on his credit report. Literally, the score was down 40, 50 points because of that collection account. That would have made the difference in about 35 or 3/8% in rate, just that one collection account, because of that credit score. So I actually I referred him over to a credit repair person who contacted Verizon. They did a workout, what have you. Lo and behold, the credit score is back up 50 points from that time. He still hasn't bought a house, but at least he is in a better position to buy at this point.
Sure. And it's really easy to resolve these derogatory items on the credit report. One time I was doing it and I had, I don't know, they claimed I missed a payment on a car lease, 8 years ago. This is years ago, and I didn't. And I sent them a letter and I said, this is incorrect. Please remove this. And they did. And it was easy.
Yep.
Right. So it's certainly a good idea to get those kind of credit report issues resolved early in the process. That's why it's a really good idea to get started early. What about some of the other options for let's talk a little bit about different loan options, like, FHA or VA or, regular or jumbo loan, or, tell us a little bit about those kind of options, Biagio.
Sure, absolutely. So all good options, and there's a lot of different varieties of those options out there. But let's talk about FHA, for example, for a minute. FHA, enables the borrower to put down 3.5%. However, there's conventional loans that allow the borrower to put down 3%. FHA, though, does allow for a credit challenged borrower, if you will, without impacting the rate. Whereas a conventional loan, if you start getting rates or credit scores down into the mid sixes, your rate's going to be that much higher. Whereas an FHA doesn't penalize you for that. The most important one in my mind for FHA, where it plays a big role, is FHA allows for a higher debt to income ratio. So when you have a conventional loan, you may be capped at 43, 45, 49, depending on the type of loan. FHA allow you to go to 54, 55 on a debt to income ratio. So again, this is where it's important to get started earlier in the process, because if today the only option is an FHA, if I have 6 months with the borrower before they actually go to buy a home, we might be able to convert that borrower from an FHA borrower to a conventional borrower, because they pay down debt, they've maybe saved some money, they've fixed some stuff on their credit, so their credit score is higher. So there's ways to, an FHA tends to be more expensive of a loan. The rate is not necessarily higher; it could actually be better, but to minimize that expense, we may work with them to try to get them into a more conventional loan. A VA loan is great, allows for 100% financing with no monthly PMI. It's probably one of the most underserved markets, I would say, because most people, or I should say most people, but most mortgage people, brokers, bankers don't lead with that product a lot and don't ask that question if someone's a veteran, but it's a great product that is utilized. I utilize it as much as possible. And then jumbo conventional, that's constantly changing. So the conventional limits this year were raised to 766,500, which is about a 5% increase from last year. And they're going up because obviously home prices are going up. That's the conforming conventional. Then there's what's called high balance conventional, which is for high balance areas. Westchester is one of them. That limit is now 1,149,000. So you can see, and that's up from like 1,089,000 and change. So those limits have continued to move up as the years have gone up. So a lot of times a borrower doesn't need to go jumbo. The advantages with not going jumbo, I'd say the biggest advantage would be that the guidelines tend to be less strict on conventional versus jumbo. Jumbo may require someone to have 12 months, 24 months, or 36 months of reserves, for example, after their down payment and closing costs. Another thing that may inhibit a client from getting approved jumbo is because of credit score. They're very, most banks, retail banks especially, are pretty, non-lenient when it comes to the credit score. So it's reserves, credit score, and then debt to income ratio. You're not, for the most part, you're not going to get a jumbo loan at a 49 debt to income ratio, where you could get a conventional loan at a 49 debt to income ratio. So those are some of the differences between those different programs that you asked me about. But again, just all rhymes and reasons about which way we would go depending on a customer's needs. So the most important thing is just to understand what the customer is looking for, what their needs are, and then we provide the best fit possible for them.
Right. The cheapest way to go is just what? Standard conventional 20% down loan. Is that correct?
Again, it depends, because if someone wants to put 100% down and go on VA, they're not paying monthly PMI. If you talk to a financial advisor, they may make the argument, put down as little as possible and invest that money in the S&P 500. So I wouldn't say cheapest necessarily. I would just say not only best fit, but what the customer really wants. And I explain all these different options to them because there is a misconception out there that I can't buy a house until I put 20% down. I mean, that's one of the biggest misconceptions out there. Most clients don't have 20% to put down, quite frankly, especially with the home prices continuing to go up and the affordability factoring in. So
I was going to ask you what your average customer puts down. Would you say it's 10 or 15 or?
It's funny. Over the year, when I worked at the retail banks, 20% and plus was pretty standard, when I was, right. And because retail banks, again, this was years ago, but FHA wasn't their strongest product, let's say,
right.
Nor was VA, their jumbo loans were really the strongest product, when I worked at a retail bank. Now that I'm in a mortgage bank, I'd say I'd see a lot more of the playing field, if you will. So I have customers that are looking for 100% financing, and I have customers that are putting down 50%. It's hard to say what the average is, but I'd say there's definitely an increase in the amount of borrowers putting less than 20% down as home prices have gone up. So I've seen a correlation between that.
Do you want to talk a little bit about investment property, like multifamily, or a lot of people are thinking about investing in real estate? Like, what are some of the options for buying a multifamily building or a building with some stores or something like that?
Yeah, so there's a big subset of mortgages, if you will, out there called non-QM, which is non-qualified mortgages. This is another advantage working at a mortgage bank versus a retail bank like a Wells Fargo, for example. They do not do non-QM loans. Well, they do jumbo non-QM, but they don't do what I'm about to talk, like the no income verification type loans. And when I say no income verification, I'll give you an example. So on investment property, there's a program called DSCR, which is debt service coverage ratio loan. Essentially, the way to qualify for that loan is to use the rental income from the property, the investment property that you're buying. And there's variations to the guidelines, but let's just keep it general for a second. As long as that rental income covers the mortgage payment on that property, you qualify for the mortgage. So you do have to have a minimum credit score, depending on the investor, maybe 620, 640. But it's not about your income. So you have a self-employed borrower that's just buying up investment properties. I'm not looking at their tax returns. I'm not looking at what they're making, what their net adjusted gross income is. I'm not looking at that. I'm looking strictly at the subject property. And like I said, as long as the rental income covers it, and it doesn't have to have a lease necessarily. It could be the market rent. So an appraiser will go out there and do, they'll appraise the property's value, but they'll also do a market rent analysis as well. And then we'll just use that rental income. So that's one example. Another example.
Does that work on, is that multi-unit properties, or does it work on a single family residence?
Single family, as long as it's an investment. So single family investment, 2, 3, 4 family investments, it works. The other, that can only be an investment. A non-QM product that you can use on owner occupied as well as investment is called the bank statement program. Again, this is a program that the retail banks do not have. They don't offer this product. Essentially, and I use this product a lot because I have a lot of self-employed borrowers. Self-employed borrower may have a lot of deposits and revenue coming into their business, but by the time they file their tax returns, they have a lot of expenses and their adjusted gross income is not enough to qualify for a conventional QM loan. So they come to me for a non-QM, non-qualified mortgage loan. Essentially what we'll do is we'll take either 12 months or 24 months of their bank statements. We'll look at their deposits. We'll apply a 50% cost expense ratio to that deposit, and we'll use that net to qualify. So easy math. Someone's depositing $100,000. They're bringing in $100,000 of revenue each month into their business. Okay, that's on their bank statement, $100,000, right? We use 50% expense ratio. Their net is $50,000. That's the qualifying income that we use to qualify. So we're using $50,000 a month of income to qualify for that mortgage. So I just had a client that purchased, a $2.5 million home using that program. They would have never qualified traditionally because there's just not enough income on the returns.
How much down for these kind of investment property loans?
Yeah, typically those do require 20% or 25%. Yeah.
Right.
Gotcha. Did you want me to show off the bridge loan products that you're also involved with?
Sure, absolutely. And Michael and I have talked about these products as well. In addition to working at Meadowbrook as a licensed mortgage loan originator, I also work at Fairbridge Lending, and we specialize in business purpose loans. Some of the loans I just talked about, like DSCR, this has to be 100% investment, so not owner-occupied properties, all investment business purpose loans. We also do bridge loan, in addition to conventional commercial loans, if you will. We do bridge loans as well, and bridge loans are short-term financing, and as the name it suggests, it bridges the gap for someone between between a bridge loan and a conventional loan, right? So for example, someone is buying a 20-family home or a mixed-use property or 20-family home in the Bronx, and there's only 20% of the units are currently rented, so it's considered not stabilized at this point. They can't get a conventional loan because there's too many vacancies in that building. Person buys a home with our bridge loan. They maybe need a bunch of rehab to fix it up or whatnot. We sometimes give them that money as well to fix up the property, and then in the course of, let's say, 6 months, a year, 18 months, they'll at that point go into a traditional commercial loan because now they'll have rented out 80-90% of the properties, so they'll be called stabilized at that point. So we take an unstabilized property and bring it to a point where it's stabilized and they can go into more conventional financing.
I see here that it's geared towards these 3 towns. What's the
it's not geared to, those are the 3 towns that we've done the most business in, but
Okay.
at the time of the website, yeah. But it's actually all, where the bridge product is actually national. Most of our business is east of the Mississippi, I would say, but it is national. We can actually do loans in almost all 50 states. There's a couple of states that are a little bit of a hindrance, like California, to do a commercial loan in.
And Biagio, you work throughout the lower Hudson Valley, all over New York State, Connecticut also, all around here, right?
Correct. Yeah.
Yeah. Good. Yeah,
And there, I put up the Meadowbrook one again, if anybody wants to find you there. But that's also streaming that email address down there, mfmbankers.com. That'll bring you here, right?
Correct.
One of the things that our agents really appreciate about you, Biagio, is your availability to answer questions. And I know that our agents, we have probably, well over 200 agents and here at Grand Lux Realty, and I know that many of them take advantage of your knowledge and friendship to call you with questions and to talk about, potential borrowers and loan products. And, there's a lot of information out there. And we as real estate agents can't be experts on every single option, but we know who to call when our borrowers have questions and our buyers need that additional support. And we appreciate your friendship with that.
I appreciate it as well. Thank you, Michael. Thanks for always having me on. I know we have our weekly Zoom calls, and your agents are great. They always ask great questions, and definitely I feel like the more questions you ask, it just broadens your your knowledge base of what's out there, and it's great that we do that.
Right. So what's the rate right now? And it's February 9th. Where do we stand? 30-year fix?
So conventional rates are now in the mid 6s. They came down a bit, from late last year when we were close to 8%, if you will, on rates. So we're in the mid 6 range now. Again, it's all very specific to borrower, credit score, type of property, down payment, whatever. But if you want a broad base, I would say mid 6s is what you're looking at. I think what you pulled up, 7.5. That's not correct. I don't know. Is that from today?
From Google, yeah. Says February 8th.
Yeah,
I mean, what a wide range of diversity there is in terms of rates and how you look it up on Google and it's one thing, you speak to Biagio and it's something completely different.
So just to reiterate, it's definitely specific to the borrower, number one, right. But also when you see these national rate, a lot of the rates that you see on Google, whatever, are national. So there's rates depending on where you are in the country as well. But again, that's not to say that someone that comes to me today wouldn't be at a 7.5, because they very well could be, because of their credit score, for example, or it's an investment property, versus a conventional versus a primary. So there's a lot that goes into the rate. And one of my jobs, like I said, is to figure out what the best fit is for the client, and that encompasses not only best price but also product as well. So it definitely varies. In terms of where the rates are going, I'd say, I think I mentioned it on the Zoom call that Michael and I had the past couple of weeks, but everyone was of the opinion that now the Fed was going to start lowering rates aggressively, starting as early as March. Again, not predicting the future here, but I do not see, I maintain that I continue to not see that happen. I don't think we're going to get rate cuts from the Fed until probably later June timeframe, if you will. And the reason for that my thoughts on that, is because the economy is still doing very well, even though there's pockets of the economy that are seeing softness, namely, mortgage and real estate have definitely seen some softness. But, as a whole, the economy has continued to do well. The unemployment rate is very low. The new job creation is still high. In fact, the latest report shows it coming up well above what the economists had expected. So I do not see and actually, Mr. Powell on 60 Minutes this past weekend kind of made it very clear that there's not going to be a rate cut in March. Now, anything's possible from now until the next month, but I don't foresee rate cuts. Now, that being said, as you can see, the rates have come down from last year without any rate cuts. And people might say, well, why? And that's because rates are forward looking, so they're anticipating rate cuts, right? So even though it's kind of been pushed out a little, if you will, they still know that there's light at the end of the tunnel here. And the market kind of predicts that and is forward looking. So that's why we're at mid 6s versus mid 7s like we were, last year. And I think that trend is going to continue. And I do feel that we'll probably, hopefully, end the year with a 5 handle on rates, which I think, and Michael, correct me if I'm wrong, I think that will make a big difference, because what I found is that most borrowers that are now, with a 3% rate on their home don't necessarily want to move and go into a 6%, 7% rate. But if they're going from a 3% rate to a 5% rate, that makes it a little bit more palatable, if you will. So I think that will hopefully increase the amount of inventory that comes onto the market this spring. And in so doing, will increase, the demand is there. I mean, borrower demand is unlike anything I've ever seen before.
Yes.
I mean, the demand is super strong. We just need the inventory. And I think the only way to get the inventory is to have people list their home, obviously. And they're going to do that, I think, with rates coming down. So I'm looking forward to a really good second half of this year, if you will.
That's great. Thank you so much, Biagio. Really appreciate you. Great job today.
Thank you.
Grand Lux Realty, we have over 200 agents. We sell over 200 houses a year. We probably are pushing towards $100 million a year in gross volume. We work in New York and Connecticut. If any of you out there ever need help or advice, we're always here to help. And we are looking for more agents too. And we want our agents to keep more of their commissions. So we offer a fast and no fee route to 95% commission splits. I believe we're the only company that offers that in our area, and agents seem to like it. So we want to grow. We've got 6 offices now, and we hope to continue to grow. And I look forward to seeing you.
Great.
Have a great one, guys. All right. Thank you, Tim. Thanks for organizing it. See you soon.
Absolutely. Great show. Thank you.
All right. Great.